Hey party people, today's video is going to be on inter/intra, not sure which one it is, group transactions. Basically the transactions between our parent and our subsidiary, and it's going to be cool. Awesome. So to start off with, let's just say up front, there are lots of transactions happening between groups all the time. Parents and subsidiaries, subsidiaries to parents, there's selling inventory to each other, obviously declaring dividends, all the time. Let's take a company like Nestle, and we're going to pretend that Nestle only has one subsidiary instead of like a bazillion. And let's call that subsidiary Nespresso. I think they're a subsidiary. And they have 75% of the interest in Nespresso. So when Nespresso declares an ordinary dividend, right, Nestle is going to receive 75% of whatever that dividend value is. And therefore Nestle, the parent, recognizes dividend income and Nespresso recognizes dividend declared. But financial reporting tells us that no, this doesn't have any economic substance because it's occurred within the group. As in, it hasn't left to third parties, it's occurred in the group, therefore nothing's really happened. So at a group level, our pro forma journal entry is going to be, 1, we're going to reverse whatever Nestle recognizes dividend income. Then 2, we've got to allocate the remaining 25% to NCI. And lastly, obviously now we've got to reverse out the dividend declared that Nespresso recognized. So this journal entry is going to look something like this. Cool. So I think this example is pretty straightforward. We just see what did they recognize, the parents and the subsidiaries. Should it have happened? No, it's Intra-group. So we get rid of it just by reversing out whatever they recognize. It gets a little bit trickier when we're dealing with assets though, because we are recognizing profits on sales and that sort of thing. But we're going to go through it and you'll understand. So we're going to do our Nestle example again. So we have our group structure. So Nespresso is going to sell an asset with a carrying amount of 100 Rand for 200 Rand to Nestle. So they've made 100 Rand profit, right? Now, because this transaction is going from Nespresso to Nestle up, it's an upstream transaction. Conversely, if it was Nestle to Nespresso, it's a downstream transaction. Cool. So as I said, we can see that Nespresso has made 100 Rand profit because that asset has a carrying amount of 100 Rand. They sold it for 100 Rand more than the carrying amount. Profit on, you get me. But the problem is that from a financial reporting perspective, in a group perspective, that asset is still only worth 100 Rand, yet Nestle has recognized that the cost price is 200 Rand, i.e. that asset is 100 Rand overvalued, and Nespresso has a profit on sale that they shouldn't have in the first place. Therefore, our pro forma journal entry is to 1, reduce or reverse the profit on sale recognized by Nespresso, and then to reduce the carrying amount that Nestle recognized because their asset at the moment is overvalued in their books. And because this is an upstream transaction, so Nespresso has recognized the profit. Nespresso also has other interests, right? The non-controlling interest. So 25% of that profit recognized must be allocated to the NCI. So in effect, actually, the effect on our profit is still only the 75 Rand that we shouldn't have recognized. Now, at this point, I feel like it is important to say there are deferred tax consequences here because obviously we've got a different tax base and a different carrying amount, temporary difference. So deferred tax, usually an asset, does arise, but because I haven't done a video on deferred tax, I'm not going to go into it yet. Just know there's deferred tax here. Now, we're going to look at an intercompany sale of inventory. Inventory is a bit trickier because the whole vibe with inventory, right, is that we want to sell it. So if Nespresso sells to Nestle, Nestle is probably going to go on to sell it to third parties. And that's cool. That's when we're like, okay, actually I do recognize the sale because we recognize sales to the extent that they're sold outside of the group. So the principle here, and it's very important, is to only de-recognize the profit on sale to the extent that it's not sold outside of the group, i.e. any inventory that we sold as into a group that hasn't left the building must be de-recognized. Okay, now we're going to do a very sexy upstream inventory transaction. So we still have Nestle and we still have Nespresso. Nespresso is going to sell inventory that cost them 200 Rand to Nestle for 300 Rand, right? They've still made this 100 Rand profit vibe. But the catch is here, by year end, Nestle has only sold that inventory that they received from Nespresso. They've only sold 20% of it, i.e. 80% still exists within the group. Therefore, we're going to de-recognize that 80%. So our pro forma journal entry now is we're going to de-recognize that 80% of profit that we can't yet recognize, right? Because it's still in the group. And then to, again, decrease the carrying amount of inventory to the extent of the unrealized profit. Cool. So this journal entry is basically debiting sales, so reversing sales, but only to the extent that it's still within the group, crediting, reversing cost of sales, and then decreasing the value of inventory to the extent of unrealized profit. And then remember, because it's an upstream transaction, we're going to have to allocate that to NCI to their portion, so 25% of the profit. And honestly, besides some deferred tax vibes and I don't know, like markups and stuff. Intercompany transactions are fine. You must just understand the principle that if it's still within the group, you get rid of it. If it's sold outside of the group, that's chilled, you recognize those sales. Cool, so I hope you enjoyed the video and that you found it useful, and have a nice day.